Right, well, thank you all for joining. As Oscar said, I'm Ella Romanos. I'm the COO of Fundamentally Games, which I founded along with Oscar. For those of you who don't know, at Fundamentally Games, we work with developers to help with commercial aspects of games. So our primary focus is on running live operations, but we also help with monetization, game design, production, access to finance, and business strategy. So my background is that I set up my first business from university with fellow graduates some 12, 13 years ago. I was originally a programmer, somehow slightly accidentally ended up running the business side of things, slightly unwillingly at first, and then gradually realized I quite enjoyed it. And I ran that for 7 years, raised some money, grew to about 25 people. Since then, I've been consulting for the last 6 years, including working with investors to provide oversight on investments they've made, and assist with due diligence for developers. I've also run a VGTR loan fund for a few years. Most recently set up Fundamentally Games, where Oscar and I raised a pre-seed round earlier this year. So I've got very sort of relevant and recent experience. So in this session, I'm going to be talking about lessons I've learned from both having raised investment myself and having been on the investor side of things when developers raise money. I'll be focusing on some practical steps to take after you've raised investment to get things going, hopefully in the right direction. I'm going to talk through some key points, and then as Oscar said, he wants to ask me some questions. So we're doing fireside chat, but we're also open to questions from you all the way through. So if you post any questions in the chat, Oscar will take a look and nudge me to answer them. So next slide, please, Oscar.
Oops. Yeah, there you go.
Cool. So we talk a lot in the industry, and I'm sure all industries do, about how to raise investment, but we don't often talk about what happens next. You know, you're obviously a startup company, you may be bootstrapping for a year or two, maybe you've come together as a new team recently, but either way, you've put together a business plan and raised money off that business plan. But then what? You know, how do you actually deliver? You now have shareholders that are invested in what you do, you have targets to meet. You also likely have a team to build and products or services to deliver. Now, in an ideal world, you'll already have started thinking about some of these things in advance, but I know how much focus it takes to raise money. At a minimum, though, I would hope and I would suggest that you agree expectations with your investors up front. And I would also suggest that you make your upfront plans as tangible and specific as possible to make it easier to start implementing effectively against them. It's really easy to focus so much on raising money that you actually forget that the plans you're making will become a reality. And from personal experience, I can tell you shit gets real very fast. So the more you can do earlier, the easier it will be. Although if you haven't gone through this process before, for fundraising and starting a company, it is much more difficult to plan up front, and experience always helps. Looking back, I acted completely differently on the Fundamentally Games fundraise and startup to what I did when I raised money and started a business straight from university, where we had literally no idea what we were doing. So, you know, it'd be interesting to know how many of you are running your first businesses, how many of you have done this before. I'd be interested to hear from you the lessons you've learned or what your biggest challenges are now. So feel free to post any questions or opinions as we go. Now, I'm assuming for the purposes of this session that you know how to deliver your products or services, that you're here because you know how to probably make games. But there's still a lot of things that you need to get set up. I just heard something then in the background, but okay, I'll carry on. And whether or not you've got experience of running businesses, it's always a challenge to get set up. It's the sort of, you're going to get overwhelmed by activities and pressures, and the tide of that is going to distract you from focusing on your goals if you're not careful, and it's very easy to do. So I'm going to talk about some tips from my own experience, which will help you to navigate this first few months, hopefully avoid some common pitfalls and mistakes that I've made in the past, and speed up the delivery of your initial goals. So first things first. Next slide, please, Oscar. So the first thing that I suggest you do after raising investment is take a step back and just reconfirm your goals internally. As always happens with fundraising, you will have iterated on your plans as you go through the process. You get feedback from investors, from your peers, and therefore, you know, your pitch deck iterates and your plans iterate and evolve, and that's a good thing. But it's really important to just take a breath before you dive in and make sure you know where you're going. You've probably defined your strategy, I hope, but you may not have defined your tactics in detail yet. You know, what specific actions or steps you need to do to deliver your strategy. What's your goal as a team? What's your vision statement? You know, where do you want to be in 6, 12, 24 months? You know, with a pitch deck and investment, we're often focusing on kind of 3 years, 5 years, but what specific goals do you have internally within a shorter period to help you to get there? You know, you can't wait 3 years to work out whether you've achieved your goals. And having a foundation stone of vision that is commonly agreed internally and then with all your stakeholders is critical to starting off on the right foot. And that enables you to take your stakeholders on a journey with you, all aiming for the same goal with the same vision. And I just want to talk about the vision for a minute, because I think that it's something that is often slightly misunderstood. So what is a vision? It's a direction, it's not a destination. I know one of Oscar's favourite quotes is that a good vision statement is like the directions to Neverland in Peter Pan. Second star to the left and straight home till morning. It sounds ambiguous, but it's a direction, and that's the point. So, you know, your strategy mindset of your big company needs to imply momentum and direction. Your specific destination and the tactics you use can change. You iterate as you learn, you pivot as the industry evolves. These are all healthy and normal things for a business to do, but you always keep true to your vision. And if all stakeholders are bought into your vision, then you can take them on that journey as it evolves, and you can justify changes to tactics based on data and learnings as you go. Next slide, please. So for many of you, this may be obvious, but the first step to get your business set up and running properly. So I'm not going to go into detail on these, but, you know, registering with the relevant tax authorities, getting payroll set up, getting an internal communication set up, which in the current climate, if you're working remotely and you're not used to it, that could be obviously something you really need to think about. Get your cash flow management set up, and I'm going to talk a bit more about that later. Get tools, software, hardware that you need. Get your brand sorted, social media, website, etc. Get your company handbook and resources for staff set up. I'm going to talk a bit more about that later. Now, all of these may be obvious, but the key really is to get these set up and automated as much as possible, because, you know, you're a small team. You've probably got 1, 2, 3 founders, and you don't want to spend all your time producing reports and managing these basic activities. Whether that means getting some resource to help, like a bookkeeper to manage your books, or whether it means software that can help to automate and manage things, whatever it is, get it set up now, up front, and try and get it running as efficiently and as automated as possible. With Fundamentally Games, I've been pretty good at this because I've done it wrong before and given myself an admin nightmare. So once you've done that, we'll move on, Oscar, please. Really one of the things to think about is reporting to investors. Now, investors don't want to get in your way, they want to support you, but they do need to know how you're getting on. And you also want them to be happy. You know, so hopefully you've got your vision defined and your goals, but happy investors generally mean that they feel informed about the status of the business. And frankly, they probably want to get that information with as little effort as required. They're busy people, they have other things to do. Now, if they're a board member as well, then obviously they're going to be more involved. But specifically here, I'm talking about people who are just shareholders. And really what you want to do is try and create a process where you can report to them in as efficiently as possible for you, but providing the shareholders the information that they need. You really want to avoid investors having to chase you for updates, feeling like they're not informed. And you also want to avoid too many questions when you do a report, because that implies you're not giving them the information they need. So again, setting up your process for reporting up front is going to save a lot of time and stress in the long run, with a little bit of effort needed at the beginning. So what I do is I set up a system and automate it where possible. Now, during the investment process, I agreed with the investors the regularity of the reports and broadly what they wanted to see in it. So we committed to doing reports every quarter. I would suggest that for a startup, that is a good amount of time, because any longer, a startup is evolving so quickly that the investors won't feel kept in the loop. It may be that as you progress, you can move to 6-month or even 12-month reports, you know, when you become a larger company with stable finances. But immediately that we raised money, I then created an initial report that set out the structure and the content, submitted that to the stakeholders and asked them for feedback. Is there anything that wasn't here? Did they want to see anything else? Did it raise any questions? A couple of things came back, and so I evolved that process. Now, you should already have clearly defined goals, as we talked about, which should mean that it's easy for you to provide progress updates against them. So what I would suggest is having a small set of goals, of key goals that are achievable and specific. So this could be revenues, number of users, dev milestones. Whatever it is, it needs to be really obvious when you've achieved it, no grey area. So the kind of SMART objectives that people talk about can actually be quite useful. So specific, measurable, achievable, relevant, time orientated. For us, we set 3 KPIs, which was a revenue figure for the first 12 months. We set a number of clients for the first 12 months, and we set a number of companies that would be on our pipeline at the end of the 12 months. So those were very specific things, very number focused, within a timeline that we knew we could do. And then in each report, I start with those and I show our progress against them. So I use a kind of RAG reporting approach which visually shows the progress along with notes where needed. And the point, what I'm trying to do is that at first glance, the investor can look at this and go, is the company on track? Are they doing what they said they were going to do? And are they achieving it as they said they were going to achieve it? So that if they don't have time to read the whole thing, at least they know that. Now, just a RAG report, I'm sure most of you know this, but it's essentially a traffic light system, a traffic light color system, so red, amber, green, as a status assessment of, identifying problem areas and potential problem areas. So, ideally they're all green, but if they're orange or red, then that might mean the investor wants to read more into the details. Next slide, please. So, you want it to be clear. You also want it to be easy to digest. So you don't want it too long. It should be well formatted, and consider the appropriate tone. For my reports, I keep them fairly informal. That's appropriate for our investors. I also always put kind of a highlight and put something, interesting in there, a cool game we're working with or something like that, just to kind of show, what we're doing and what we're working on. But, some investors may require something more formal, and that's fine. But making sure that whatever it is well formatted and short as possible is useful. And unless you know that every single one of your readers understands all of the jargon of the games industry, avoid it. I've worked a lot with non-game specific investors, and at one point they asked us to write a list of jargon because they just didn't understand all the things that developers were talking to them about. We said, yeah, we'll do that, thinking it wouldn't be bad. We ended up with a 14-page document of different terms that we use. So don't underestimate how much jargon there is that you really need to clarify if your readers don't necessarily understand it. And it's really important to understand what matters to your investors. What is it about your vision that they've bought into? What is it that they care about? What is it that they worry about? It'll be much easier to write your report effectively if you know what it is. Are they focused on the details of the cash flow, or are they focused on the bigger picture? Are they going to want detailed management accounts, or are they happy to just know your runway? The more you can double down on why they invested in you, the more you focus on that, the easier it will be for them to understand your business, even if they aren't from the same industry, and even if they're very short on time to read what you report to them. So make sure you're clear on your commitments. What do your company articles, shareholder agreements, or other promises you've made during the investment process entail? Are there specific things you need to report or provide? Did you commit to how often? And being upfront when things don't work is critical. Don't dilute bad news, but try to mitigate it. So my rule when I give bad news to anybody, not just investors, but generally in life and work, is that I only give bad news along with 2 other things: full information on the potential impact of that bad news, and full information on my plan for mitigation. Because without those, all you're going to do is cause concern and raise more questions. But don't avoid giving bad news. Don't delay it. Don't think, oh, it may not happen, therefore I won't tell them yet. That's the biggest mistake you can make. I've done it, and I can tell you it's a bad idea. Give it in advance as much as possible, as soon as you know. You're making a commitment to investors by taking their money, and you do have a responsibility to be honest. I also think that it's important to talk about the difference between a shareholder and a shareholder director. We often in the industry talk about dumb money, which is a phrase I hate, but often developers want to find investors who provide smart money, as in not just cash. They provide support and other knowledge. And often investors use this as a selling point. Now, that can be really good, but I don't really believe that we should see smart as better than dumb money. Smart money can be really, really good, but it doesn't mean that money on its own isn't good. You can get support aside from the money. And what I would say is that if you are looking for smart investors, then you need commitment from them on what support they will provide. You need specific goals and expectations set on how that will work, just as they expect it from you on your business. Do not see support as an intangible benefit to money. Do not forget that you are responsible for running the business, not them. That's why they invested in you. Smart money can work really, really well, but only if managed appropriately. And I would say don't discount what we call dumb money, because it can be equally useful. So just to be a bit more specific, this is how I structure my reports. There are a million ways to do this, but I thought it might be useful just to talk through it. So the first, as I mentioned before, a visual summary of the status of the business. I focus this on the KPIs. My target is to always have 3 key KPIs, and I do it, currently I've got it as 12-month targets. Internally, to be clear, we actually have monthly targets within that, but for the investor's point of view, I look at the 12 months. And in each report, I update our progress against those with traffic light colors and text and so on. I then outline the key activities and decisions we've taken in bullet points. And then I do the same for the key activities we're planning to do up until the next report. I try and keep these simple and to the point. There's a lot of things that you think are important that might not be important for the investors. So just think about what really matters to them. I then go into detail in areas that needed. So at the moment, I have a section on investment update because we're trying to raise more money. I have a team update because that's our key resource and our key sink of cash. I also actually at the moment have a section on the impact of COVID-19 because that's an important thing right now. I then have a cash flow section and I summarize this clearly with visuals showing where our runway is. And I also show any changes in the cash flow since the last time. Obviously, 200 quid here or there, for a different tool is not a big deal. But if, we've decided to hire another person or to do something that makes a material impact on the cash flow, I very clearly state that. Now, some investors may want full management accounts. This, certainly becomes more important as you're revenue generating and profitable. And some may want it from the start. Ours don't. And really, at this stage in the business, cash flow is really key. So we focus on that. Okay, and then just sort of some last considerations and this is from my experience of having to review reports. So from the other side, make it consistent. I've reviewed a lot of reports on behalf of investors, and the single biggest waste of time is when a report writer doesn't make the report consistent with the previous report. So, what I do now is I start with the previous report, I copy and paste. And so, in the previous report, I've said in the next 3 months, we're going to do X, Y, Z. I copy and paste that into what I've done in the last 3 months. If I haven't achieved those, or if there's been a change, I then add that as a note. But so if somebody looks at the previous report and my new report, they can see, oh yes, they said they were going to do that. Okay, they've done that. Or, oh, they haven't quite managed that, but this is why. It may sound minor, but honestly, it is possibly the most important thing you could do. And the thing that I see the least, very few people do this in my experience. I can't tell you the number of hours I've wasted trying to work out whether a developer has done what they said they were going to do or not. And I'm often left questioning, are they just not good at writing reports, or are they actually trying to hide something from me? And that's the problem. Also, as a minor thing, tell them when the next report is coming, because I can guarantee that busy people won't remember that you've said the next report is coming on the 20th of December 2020. Just give them the dates at the top of the report of when they're all coming along. Now, all of this may sound like quite a lot of work, but if you create a process, I take probably 2 to 3 hours a month to write, a quarter to write our investor reports. And from the feedback I've had, the investors feel informed. I get very few questions, but most importantly, you want them to be on your side. You want them to feel informed. You want them to feel happy about their investment. And then, the last point really on this section is that plans always change. Next slide, please, Oscar. You won't achieve exactly what you forecast when you forecast it, but being transparent about that, explaining things and the impact means that when things go wrong, and I do say when intentionally because every business goes wrong at some point, you will hopefully have the support of your investors rather than investors who feel they haven't been given the full story. Your good communication leads to trust and support, and that's what you want from your investors. If you do this in the good times, then hopefully that trust and support will carry over into the bad times. So I'm going to talk a little bit about team now, because at this point you've raised money, you're likely under pressure to deliver, and that probably means that you need resource. But hiring the wrong person can be disastrous. So you must allow yourself time to recruit. And it's so tempting, and I've been there and done this myself, to feel like you just need someone and that having someone is better than not. And you can be either consciously or subconsciously biased into kind of thinking, well, this person's okay, right enough right now. But I can say that that is not the case. You are better off extending your timeline, adjusting your goals, and putting in place mitigation strategies for continuing without a certain resource than rushing into hiring people when they're not quite right. And that's, it's fairly obvious that employing the wrong people is a nightmare. I don't think any business owner would say, no, that's not obvious. But what I've learned through making these mistakes is that, yes, it's obvious that, it costs money, that it causes problems on projects, that it takes up your time. Those things are all obvious. But what wasn't obvious to me until it happened was that actually there is a much bigger effect of employing the wrong person than just the direct impact of that person, because actually what it does is it compromises the morale of the team and ultimately the company culture. For one example, if you take on someone who hasn't got the skills to do the job, they may work really hard, but that will put pressure on the rest of the team. Now, the team will see that the person isn't suitable for the job, and actually whilst you're trying to work out how to support the person to increase their skills, how to fix the project that's been affected, how to actually, make sure that, you resolve the situation, hopefully by supporting the person to grow. Under the surface, the rest of the team are being put under a lot of pressure because they're potentially having to pick up the pieces, or maybe you're too distracted to focus on them, and so on. So when you manage to resolve the immediate issue of, hopefully, bringing that person's skills up, the effect on the rest of the team has already happened. And, it may be under the surface so you don't notice it initially, but it really can create culture and morale problems within the team. And then the more damaging problem could be taking on someone with a bad attitude. And just one person who has a negative attitude or an ego or something to prove can really sow discontent through an entire company, particularly if that person is in any position of power, whether that's actually in terms of their role or their perception, the peer sort of perception, and whether they realise they're doing it or not. I'm sure everyone has worked with someone like this, someone who likes to moan, likes to find reason to complain, has something to prove, talks about people behind their back, or just hates management simply because they're management. But it's often really hard to pinpoint when this problem is occurring. And if you do pinpoint it, then it's often hard to deal with and very difficult to prove. But the impact can be extremely severe on morale and culture. And it can really quickly change the culture in the studio. And again, that isn't resolved when that direct problem has been sorted. So when you're hiring, the thing I always say now is that if your gut tells you that they're not the right person, I don't care what's on paper, don't do it. You have to find a way to figure out their attitude as well as their skills. But to be clear, attitude does not mean thinking the same as you and being the same as you. Don't fall into the trap of hiring people who are like you. Diversity is just as important, particularly in the creative industry. But everybody who is there must have a positive attitude to the team, you and the business. And hopefully you're going to be hiring people who are better than you. That should be your ultimate goal. So next slide, please. Once you do make some hires, though, it's important that all team members are supported in their roles. So even if you're only hiring 1 or 2 people, this still applies. You need to ensure you have the processes in place to onboard them, support them, and have clear expectations defined. Make time to do regular reviews, work with each team member to support their personal development, and make sure that the processes for day-to-day working are effective for the new team, and ultimately make sure that they're fulfilled and happy, because that will help them to help you deliver the company goals as effectively as possible. So processes that I've done over the last 6 months. Firstly, I created a company handbook. This really triggered us to think about the type of company that we want and the culture that we want to create. So priorities for us, for myself and Oscar, were to create support our team in their careers as well as their roles, diversity, and encouraging everybody to take responsibility where appropriate. We also know that as a startup, we can't compete with big companies in terms of salaries. So, we took the approach that we want to create an environment that people want to work in and provide benefits where we can. So key considerations for us were a flexible working policy. Now we have this has been really important to us. So we have extremely flexible working to the point where somebody can work 4 days a week rather than 5, or they can split their hours so that they can take their kids to school. Whatever it is, that's agreed on a case-by-case basis, and our team do all actually take advantage of this in ways that work for them. We also have our own projects policy, so we allow and encourage people to do their own non-commercial projects, whether that's attending game jams, even in work time occasionally, or creating their own games. We also have remote working. We were already remote before the lockdown, and we intend to be. So we have policies in place for that. Obviously, if that's something that you're not used to, then at the moment that's probably a challenge. And then personal development plans. So we set up PDPs with each employee when they start. They have actions and tangible time limited goals. We review this initially every 3 months, and then it moves to 6 months. These goals relate to their roles, but also their careers. And that's really important. It's not just for us, it's for them as well. We have a small training budget that the team can access to buy resources, go on courses, go to events. And we also include, in some cases, shared goals where 2 team members actually need to work on something together. That's quite important to encourage collaboration. And then we also ask for feedback during these sessions. And I hope I'm right in saying that our team feel comfortable giving this to us. And then obviously appropriate behaviour policies, which cover a whole range of things, but it's really important for us that those are in place. Hopefully we'll never have to use them, but it's really important to consider these things in case something goes wrong. So I want to talk now a bit about cash flow management. As with investor reports and, well, most things, time spent early setting up makes life easier going forward. It will also help you to make informed decisions, reduce errors, and spot problems early. I spend now about 3 to 4 hours a month on our cash flow management. I do have a bookkeeper, to be clear, who inputs the books, but I actually, in terms of cash flow and forecasting, I've got it down now so it doesn't take me too long. It also enables me to output information for my investor reports, or for anyone else who wants to know the status of our cash flow at any point really easily. There are many ways to manage cash flow: daily, weekly, monthly. Monthly is the most efficient in my experience. However, if you're tight on cash, you may want to move to weekly. I have seen some people do daily, but the thought of it gives me a headache. So I'm not quite sure what the advantages are. The most important thing is, though, it's reliable. So whatever you do, you need to know it's accurate, that it's easy to understand for you, for your co-founders, investors, and you need to know that it's up to date. So and then runway. So startup, this is really what matters. When are you going to run out of money? Knowing you can pay your bills, knowing you can pay your staff is really important. And at some point, yes, you're going to focus more on profit. Hopefully your runway will be, longer. But in those early days, it's really about knowing what cash you have to spend and knowing the information and having the information to hand when you make decisions. And you know that the information you're working from is up to date and accurate. I would say, though, that, and this is a sort of mistake I made in the early days of my first business, is that cash flow isn't the only factor in decision making. And as a startup with limited cash flow in my first business, I perhaps focused too much on cash flow to the exclusion of other longer term factors. Specifically, you know, as a work for hire developer at that point, I was really focused on, you know, what projects make the most money so that we could keep going as a company. And because I was worried about paying bills, which was a really good strategy in the short term, but it didn't really encourage longer term thinking. And after a few years, I was talking to an advisor, and they gave me some advice which really helped, so I thought I'd share it. The premise that they said was that for every piece of work you consider, whether that's working for clients, a new game that you're looking to make, whatever it is, you ask yourself 3 questions. One is, does it make you a good amount of profit, increase your runway? Profit being really the key rather than runway, but early on I know that runway is really what matters. 2, does it build your team skills? And 3, does it help build your reputation? And the idea that this advisor said to me was that only take on projects which tick 2 out of those 3. Try not to take on projects which only tick 1. Now, in practice, you know, sometimes you're short on cash, you need a project to fill a gap. Absolutely fine. But thinking in this way really helped me from going from a business owner who was just worried about paying bills and stressing about that to actually being able to think a bit longer term about what was good for the business. So, next slide, please. Scenario modeling. So this was something that in my previous business, I just used to use a Excel spreadsheet to manage my cash flow, which kind of worked. It was a bit of a pain, took more time, but what it didn't really enable me to do was effectively model scenarios. You know, what happens if the game we're launching doesn't generate revenues as quickly as we thought? What happens if a client doesn't pay their invoice on time? What happens if the role we're currently hiring for at the moment needs a higher salary? You know, and this all feeds obviously into your bigger business plans. Next slide, please, Oscar. What I discovered, because when we started Fundamentally Games, I realized that I needed a better way to do this, was I started using Float, which is floatapp.com. So for those who don't know, Float pulls all your figures from 0, assuming you're using 0 for your books. It allows you to forecast, it allows you to clearly see your runway, model scenarios, and track actual spend against forecast spend. So if you look at this image here, you'll see that there's an orange line and a blue line. So the blue line is your base scenario, so that's your actuals. You can then create different scenarios, and then it will show you the impact on your cash flow visually of that scenario. You can create as many scenarios as you want. So, you know, when I'm looking to hire a new person, I create a scenario. You know, at the moment we're looking to hire a community manager. So the other day I went in and I said, right, what's going to happen to my cash flow if I hire a community manager from November? And rather than having to mess with everything and then pull it back and so on, it just enabled me to look at the different options. And that's really powerful. It also allows you to see when your cash flow, when your runway ends. So you'll see there it says 15th of March 2020 in this example. You can set that to whatever figure you want. So this person's got it set to 0, but I actually set mine to tell me there the date when I get below 25k, for example. And then if you look at the bottom, you'll see that next to the sales row, in the sales row, there's a bar that's half filled. So what happens is that you put in your forecast budget for the month in each line, income and outgoings, and as real money comes into 0, it fills those lines up. And at the end of the month, you can see where you've gone over, where you've gone under, and in some cases you have to make corrections just to make sure that 0 is giving you the information the right way. So to get this set up properly took me a day or so. At the beginning, I didn't know the system, but it's very easy to do. Now I spend, 2-3 hours a month. Just at the end of the month, the bookkeeper does the books on 0, and then I go through this and just make sure everything matches. Really efficient, and at any point in time, anyone could go in and see where we are. That's honestly been one of the biggest transformations to my efficiency and not having to focus, you know, not having to spend all my time managing a spreadsheet and being able to trust the information that's there. Okay. So you're likely really busy trying to get things started, growing your business, but it's really important to be able to take a step back and review progress at regular points. Hopefully you do this at the beginning, but you need to keep on doing that. And you know, having to do regular reports for investors can be a useful mechanism, but in reality that's fairly high level, and really what you need to do is a more regular, a more granular level of detail review. Good way to do this is to set up processes. Now, it's really hard when you're busy, when you have nobody external to do this with, but you need to define some KPIs that maybe are every month, every 6 weeks, that you can assess, and you need to set time aside to do that, and ensure that everybody in the team is working towards those goals. And also make sure that you're recording progress. It's much easier to set up this process at the start when things are going well, because not only will it allow you to identify potential issues earlier, giving you a greater chance of fixing them, but it's also really difficult to look up when you're struggling, because the natural thing, and I do this, is that when things are not working, you dig yourself deeper because you're really just trying to fix it. And sometimes what you actually need is just to take a step back and go, okay, what do we do? One of the most useful pieces of advice I was ever given that really helped me with this, again, in my first business, I was very bad at doing this initially, is to make decisions like you're 6 months ahead of where you are. This means that it helped me to look forward more rather than look at the right now. Now, it helps you to plan ahead. It is hard to apply because it does increase the amount of risk in your decisions, and it's sometimes hard to convince yourself and your colleagues about this. And it should not be applied blindly. This is not a hard and fast rule. It's more a way to guide your decision making, and it helped me in several ways. It helped me to look ahead more than I used to. It helped me to make decisions rather than putting them off. And I think actually that was possibly the most useful thing. It made me step back and evaluate more. And really having this in the back of my head helps me to continually strive for the future. And I would actually say that I do actually do this in my personal life as well, because in my personal career, because thinking about the future can be really hard, and taking that step back. And I'm sure there's other methodologies for doing this, but for me, this has been a really useful one. Next slide, please. So if I had to define the single most important skill for anybody running a business, in my opinion, particularly for a startup, it would be this. You need advice and feedback. You don't know everything, and you never will. But it's actually hard to ask for advice because it takes a lot of confidence. People often don't like to admit they don't know, or when they've made mistakes, because they think it's a sign of weakness. I see a lot of people starting out who are nervous and want to prove themselves. They feel that they need to pretend they're more experienced and knowledgeable than they are, but it's totally counterproductive. In my experience, if you ask for help, people will give it to you, and they will think more highly of you. And you really need that help to succeed. You can't do this alone, no matter how experienced or inexperienced you are. Anyone who thinks they can start up without that kind of help or advice from those who've gone before them is setting themselves up for a lot of pain. However, that doesn't mean that you just do what people tell you. People give you advice based on the information you give them, the experience they've had, the fact, there's various factors. So take the advice, take as much as you can, whether that's feedback on your game from players, customers giving you feedback on your offering, your peers giving you advice, a business advisor, and then make your own decisions and go your own way. You need to consider it carefully and iterate on your plans, but do what you believe is right. You don't need to feel that if you've taken advice and ignored it, that that's not being useful advice. It has. But just make sure that when your plans do change, you're clear to yourself, to your, obviously to your founders, to your team, to your stakeholders, what this means and why you've done it. And I would suggest recording it, because if you make decisions that then prove to be wrong, it's useful to understand the thought process that was going on at the time. Hindsight is a wonderful thing. Okay. And then just next slide, please, Oscar. Obviously, it's great to get feedback and advice from a lot of people, as I've just said, but it's also useful to have a more formal advisor process, whether this is board members or whether this is an external advisor. It can be really useful to have somebody providing consistent external perspective on your business, particularly where that advisor has specific skills or experience that maybe you don't, or that would benefit your business. So they could be shareholders, they could not be. It could be a monthly board meeting, it could be a more informal chat every few months. But it's really useful to be able to explain your progress to somebody over a period of time, and get the sort of feedback from somebody who isn't living it every day, but who also has been there on your journey with you. Next slide, please. And then you're pretty, once you've raised investment, you're probably pretty exhausted, but probably pretty elated, I hope. You've likely been very stressed, working very hard, and now you've got a ridiculously long task list, new team members to train up, a lot of pressure to deliver. We don't really talk that much about personal stress and exhaustion of running a business, but we should. Not only is it not good for you to be stressed and exhausted, it's not good for the business either. And you really should consider also that culture comes from the top. So setting a good example is really important. So you should be planning to have some downtime once you've raised investment. Now, it might not be possible for the first few months, and I don't know what questions Oscar's going to ask me, but I can tell you for a fact that that was tough for us. But it should be a key priority for you to get to that point and to give yourself some space to be more effective at your role. You can't carry on indefinitely without a break. I did that in my 20s. It worked for about 6 years, and then I was completely burned out. Now I'm much more careful. Oscar's terrible at it, but we're working on it. But you don't want to do that. It's not actually good for the business. Your decision making will be compromised. Your ability to deliver will be compromised. I talked earlier about stepping back and looking up. If you're too tired and too stressed, you're going to struggle even more to do this. So, take time to make sure that you actually can be the most, optimal in your role. And that means not just working all the time. Okay, next slide, please. So that's it really. So in summary, those first few months after raising investment can be really tough. There's so many things to do, many of which may be new to you as a startup founder, but taking the time to get things set up correctly now will really help pay off later and will help to set the company off in the right direction. I think, as Oscar mentioned later, we have various free resources which can help with various aspects of business. So please take a look at our website. And I think Oscar might have some questions for me. You're on mute. You're on mute, Oscar.
I seem to have killed the share screen as well somehow. I'm not too sure how that's happened. Anyway, so that's all part of the fun of it. So there's a whole bunch of stuff that I think we could cover off. Obviously, please feel free to answer, ask any questions you guys have got in the meantime. But I think it's I think key to this stuff is really understanding, when, setting up your kind of principles at the beginning. One of the things that I think you didn't go into a lot of detail on, because I think you're a little nervous about talking about company culture. I know this, but actually, I think there's something that you kind of hinted at, the company handbook thing. Now, I think most people won't really understand why that matters. I know I didn't, but I think you spent a lot of time writing a lot of documents around kind of hiring processes, about business processes, about accountability, about all this kind of stuff, and that you happen to have some to build on. But what is it? How do you explain to people why that is so important? I think it's worth exploring that a little bit more.
I think that it can become so. I'm going to talk about when I didn't do it in my previous business, because actually that's how I learned why it's important. So what happened in my previous business is that we started off small. We were graduates. We then hired one person, two people, and so on, and it was fine. I think probably in hindsight, they understood that we were new to this as well. And so perhaps they were more forgiving. I didn't realize it at the time, but just thinking back to it. And then we got to 8 people, which, and then we grew a bit more, and then we grew a bit more. And suddenly it was chaos, because, we had no defined expectations, and we had no, in reality, defined policies. So, I mean, I had to, for example, an employee was working on a project for a client, and, on their Twitter account, they said who they worked for, and they started bitching on Twitter, didn't name the client, but, we didn't run that many projects at once. And they started bitching about how the client, what the awful feedback, and how, I won't say what they said to you, but it was, and when I pulled them up on it, they said, oh, I didn't realize that would be a problem. And I thought, well, that's, I mean, what? But the point was that I hadn't defined it. We hadn't set the kind of expectations, and we were a young company. We were very informal in a lot of ways. Now, obviously, that was stupid. There's no way. But we hadn't set, and that's a really extreme example. But there was a lot of things like that where we found where actually things that you think, oh, well, that's obvious, aren't obvious, and it's really important to set those expectations and to sort of set the culture that you want to create. And having not done that in advance before, and then having to do it at a point where the culture was already being impacted by the lack of it was really difficult.
Yeah.
And I don't think I necessarily, and I don't think I ever really, with my previous studio, got to a point where actually it was right, because I think we didn't do it in advance. So yes, it might seem preemptive to spend all this time writing a company handbook when you've got one employee. But if your plans are to grow, and I actually would argue that even with one employee, it matters.
Well, I think it's also a question that comes into that, which is also tied to the culture and also tied to some of the other stuff you said. And I think for me, this is about the decision of what kind of relationship you've got with your team. Are they a team member? Are they part of the company, or are they just a drone who is an employee? Now, I mean, there's actually nothing wrong with having organizations that have drones. I have, in a horrible word, but I don't mean it in that negative way. I mean, in terms of, for some people, I turn up, I do the thing I'm supposed to do, I move on. I don't think most game startups are that. I think most game startups, it's that balance between accountability and authority. And if you don't give people the authority to do their job and to take accountability, then it does open out this risk of them making stupid comments online because they don't feel accountable for the results of it. It for me, it's about making the kind of negativity that has an effect on other people in the staff, because they don't see the correlation between what they're accountable for, what they're responsible for, and the outcome. And I think the more you build up this accountability authority balance in your team, the more effective they're likely to be as well. Is that part of where we are here? Is this why company culture matters?
I think that the tendency, and I've done this and I've also seen it, there is a tendency to go too far one way or the other. So perhaps not so much in games, but I'm sure this happens in large companies, like you said, is to kind of take responsibility or away from employees, or certainly not feel like they need to necessarily be invested in the vision. The other end of the spectrum then, this is what I see more commonly in games and in startups and indies. I think this is particularly because we're all in this because we love it. A lot of us are not business people, we're actually game makers. And, because, we want our employees to feel part of the team, which is the right thing, but that can go too far. And, the result of that the other way is that actually it's too informal. You are running a business, and ultimately you have to make money. You may have stakeholders, but even if you don't want to become Supercell, you still need to make enough money to make your next game. And so you do have to operate professionally. And I think that means, that you have to, have processes, you have to have boundaries, you have to know who's responsible for what, and all these things are really important. And actually, if you set those from the beginning, then you can create a really happy, productive, and environment where people are responsible for themselves, but equally where you are a professional business and you're not, some of the things you see is decision making by committee, pet hate of mine, and equally giving too much. It's not the employee's responsibility to worry about your cash flow. But I've seen cases where, developers are too open with their employees. So it's a really fine balance. And I think that by writing the company handbook, not only does it give information to your team, but I think it actually helps me as a founder. And I hope you, Oscar, having read through it, but helped us to work out what it is we wanted to create in terms of culture.
It creates boundaries. Healthy boundaries about what the expectations are. And I think kind of key to what we're trying to do is we want to empower our team to deliver what the company needs. But we're responsible for the company. They're responsible for their roles. And I think one of the things that's been really useful for that as well is one of the kind of arguably on the kind of COVID cultural things, which is not necessarily related to what you should do once you've got investment, but I think it's still an interesting thing, and I think it explores this, is creating kind of that water cooler culture model. So creating kind of this ability to interact with people on a social level and make sure that's specific and defined in a different way than their professional responsibilities. So we do a few things like we effectively record, we're not releasing them at the moment, but we're effectively recording podcasts where we're debating issues related to our jobs. And we're recording those as like 20-minute blocks, and maybe one day we'll release them. I don't know. But the point is it creates a context where we're talking professionally, we're sharing information, we're teaching and learning from each other, and we're providing the ability to test dialogue. You know, basically the ability to argue with each other professionally, disagree with each other without it having inappropriate consequences. And that, I think, has been really important to create a way to communicate as a team. And I think that's a different thing from the company manuals. But I think it is also part of this idea of really defining that your culture and your culture through leadership, not just through kind of
yeah. And I think the risk of talking about company handbooks too much is it sounds like it's just an admin like thing that you'll post and nobody will ever read it. Now, you know, the people probably won't read it that much, but it's really, for me, it's more of an exercise to define all those things you just said. So, you know, certainly when you came up with that podcast idea, that was because we were saying, well, we want to, you know, allow people to build their careers as well as their roles. And, you know, we want to encourage input into the team. And, well, you know, and that came out of that discussion. So, you know, when we say company handbook, yes, it is a set of documents, which are living documents, and I do update sometimes, but, you know, it's really, that's just the kind of methodology to allow you to get to the point of defining your culture. And if you don't, you know, if you don't want to write a company handbook from day one, you don't have to, but I do think you need to define the expectations and the policies and so on.
Absolutely, and create those boundaries. And I think we actually did use that kind of corporate kind of consultancy model of having some vision statements. Ours were curiosity and tenacity, which is a kind of how we define ourselves so we jokingly refer to Ella as Tenacious E, and me as the chief of curiosity. But that's us. That's our definition of what fundamentally games is about, and we've tried to incorporate that in the way that we engage not just with our team but also with the investors. And having that kind of combination of tenacity, curiosity means that we're continuously exploring how we build and manage our relationships outside of the organization as well. One thing I was going to add, we're kind of about to run out of time, but I think one thing that was also interesting, it's worth kind of noting, is that you talked about runway earlier, and it being more than just how much money you have. I think one of the most interesting things for me that we've learned through this process is just how focused we've been on not just working out when the money comes in, but how long it's going to take for us to get the money to come in. So thinking about, you know, how long do deals take? How long does it take from a deal to a release? And then from a release to the revenue? And thinking about that entire length of journey, not just how much money do we have left, but what have we got to do with the money that we've got left? Yeah,
so my general policy when it comes to estimating where you have revenue that, you know, you're relying on other people for, is whatever you estimate, double it, because you can't really go wrong. If it comes in earlier than you anticipated, it's bonus, but if it comes in later, you could run out of money. So you know, if you think that so you know, if you
always double it.
I mean, at a basic, like, if you send out an invoice and it's got 30 days on it, assume it's going to come in after 60. And if you assume that a game is going to start generating revenue after 3 months, I would make it 6 months. You know, and that's that sort of thing. It's just because you can't really, it's not a bad thing if money comes in earlier. So just be really, really pessimistic, in my view.
Exactly. So last chance for you guys. If you have any questions, please feel free to use the chat. I think most of you have done that so far. Otherwise, we'll have to say thank you very much. Thank you for joining us. I think hopefully you've got a lot from this. I know it reminds me of how far we've come. You know, and all that time watching Ella writing all these documents was really well spent. Notice I didn't do that. I'm just the strategy guy. I'm the curiosity guy. But actually looking at kind of making sure that we get this stuff. And Ella's point was really key as well. I mean, I am terrible at taking breaks, and I have to be forced to stop. I'm not too bad at taking time out during the day, but I'm not good at taking weekends off, which is awful. Don't be me, be Ella. So yeah,
Cool.
and
thanks all for listening.
Yeah, thank you all for listening. And James, don't worry, you'll be getting a copy of the recording as well. And so I think that's it. I think we have no more questions. So don't forget that you can check out the fundamentally.games website. There's an event directory now. There's a finances list if you want to find more money. We have a bunch of templates, and we also have a knowledge base where recordings like this will go. And obviously, if you want to talk about live ops for your games, you know where we are.